Good evening, friends. A very warm welcome to all of you all to this second quarter discussion on the outlook for markets and an update on the Renaissance portfolios. I welcome all of you all to this webinar. While it's been about 3 months, we spoke sometime in early July, and it's been about 3 months since then, but it feels like we are talking after a long time, and that's primarily because there is so much that has happened in the last 3 months. It's been a very busy or a very eventful quarter, and I intend to take you through some of those developments that have happened in the last quarter. Primarily, when you spoke in July, what we were really expecting is a favorable trade deal that India would strike with US, and what really turned out to be was exactly opposite of that, and as a consequence it created its own set of economic and geopolitical challenges for India, and India has responded to that by announcing its own fiscal stimulus. So we'll talk about all of that and what does it mean for markets. Markets have been quite challenging in the last quarter and for the last 1 year, so I'll touch upon that as well. So we have quite a lot to talk about, so let me straight away jump into our presentation that I intend to take you through during the course of this conversation. I've always said this: India is in the midst of a growth super cycle. I think that remains very much in place. India is, as all of us know, now in CY25 current year, we are clocking $1 trillion of economic output on a quarterly basis, on a quarterly run rate basis. So we are a $4 trillion plus economy. And I clearly see that we are in the midst of a growth super cycle, which effectively means that we'll double our economic size in the next 7 to 8 years. So India will become an $8 trillion economy, and nothing changes on that count. So India is in the midst of one of these most magical growth super cycle that I call it. In midst of this, the two big events which captured last quarter most of the time and attention, one obviously was clearly a significant fiscal stimulus that was announced by the government, and actually not only announced but also implemented within the quarter. So now if we see over the course of this year, right from the start of the year, the government has been on a steady path of injecting a significant monetary and fiscal stimulus in the economy to revive the growth in the economy. All of us know that growth has slowed down quite sharply in the second half of last year, and more primarily in the second and third quarter of last year. So now if you put all of the stimulus that's been announced so far, we've had two big fiscal stimulus. That is the income tax cuts that we had in the budget, which was to the magnitude of about 1 lakh crores. And now this GST cuts which have been announced and implemented, that's another about 1.8 lakh crores. On top of that, all of us know RBI has cut rates by 100 basis points this year, and that effectively amounts to a monetary stimulus of about 1.5 lakh crores if we bake into account all the savings that occur in EMIs on all retail loans, that's car loan, home loan, credit card loans and everything else, and put together all three of this amounts to a stimulus of about something order of 4.5 lakh crores, or close to about, I would say, about 60 odd $billion, which is about close to 1.4% of India's GDP, which is very significant. I think I think we'll start seeing the benefit of this accruing over a period of time. While the initial response has been seen in terms of the very sharp spike in demand growth that has happened during the Navratri festival season, but more importantly, I see that this demand revival sustaining over the medium term, and we realizing the full potential of it over the next 12 months. So it will be somewhat gradual, but I certainly see meaningful recovery in the consumption spends in the economy, driven by this fiscal and monetary stimulus that's been injected into the economy over the last 9 months. And as now the money has actually started trickling into the pockets of the consumers in terms of tax cuts and the RBI rate cuts as well. And more importantly, we expect sometime in the probably in a year's time from now, the 8th Pay Commission recommendation will also be implemented. The government has already announced at least the formation of 8th Pay Commission, and if that gets implemented, let's say by somewhere around same festival time next year, that will be an incremental payout in the hands of government and defense, all the government employees across central and state governments and defense and allied forces, to the magnitude of 1.8 lakh crores. So I think this whole recovery in consumption, which we are in the early days and we are seeing early signs of it in terms of what we've seen during the start of festival season during Navratri, is going to sustain and more importantly gradually build from here. So I think we are in for a very meaningful consumption recovery from here over the next 6 to 8 quarters. And more importantly, all of this gives us enough confidence that the cyclical slowdown that the Indian economy has been witnessing over the last 6 quarters is clearly, the low point of that cyclical slowdown is clearly behind us. And the economy is on a path of recovery. The recovery could be somewhat gradual, but we are certainly on a path of recovery. Obviously, the second big news that drew everyone's attention for a significant part of the quarter was essentially the announcement of tariffs and then subsequently punitive tariffs on India, which was completely unexpected. So now if you see, friends, with that 50% tariffs, which is 25% base tariff and 25% punitive tariffs, India is actually the second highest tariff country in the world by US. So the highest tariffs are obviously on China, and if you apply these 50% tariffs on US, India's aggregate trade exports to US, that on an aggregate basis amounts to something like about to the order of about 35%, and which is second highest tariff that US has imposed on any country after China, and which is at par with Brazil. So obviously, while India's exports to US are not significant as compared to a lot of other competing countries, only 2% of our overall GDP growth comes out of US exports. Yeah, so our dependence on US exports is very small. 2%, if India is growing at 6.5%, then 2% growth coming out of US means 2% of 6.5%, which amounts to about 15 odd basis points. So a very small fraction of India's aggregate growth comes out of US exports. So our dependence on US is pretty low. But at the same time, the fact that now we have the second highest tariff in the world, or we are the second highest tariffed country in the world by US, does put India at a very disadvantageous position versus all our competing neighbors, because a lot of our competing neighbors for whom we compete with in the US markets for exports now have tariff rates which is much lower than India. So that does to some extent impact that whole idea or that growth momentum we were expecting of companies relocating their supply chain out of East Asian countries to India. That is certainly put on a pause for the time being. And clearly the most impacted or the sectors which are at the most disadvantage from these high tariffs are essentially sectors which are more more labor intensive or labor oriented, and some of the sectors with high exposure to US exports clearly are gems, jewelries and diamonds, textiles and apparels, marine products. So obviously all of these sectors will get meaningfully impacted, at least unless and until we get this thing sorted out. And there could be some spillover effects on some of the other exports as well across pharma and engineering goods. Pharma for the time being has been spared, except for new molecules on which fresh set of tariffs were announced a week back. But there will still be some spillover effect on engineering goods and some of the white goods that India is exporting, engineering exports that India does to US. My take on all of this is I still think that it's a matter of posturing, and because President Trump could not or has not been able to successfully stop the Russia-Ukraine war, which he's gone on record multiple times saying that he'll bring a pause in that war within a week's time. He had to do something, and then given the fact this was one of his ways of trying to demonstrate to the world that he's doing something about it, and where he's also pushing NATO countries to stop buying oil from India. But having said that, all of us know that Trump starts his bargaining from a maximum position kind of a thing, and then he retreats. I certainly think there is a deal down the road that lies for India with the US in terms of a bilateral trade deal, and probably with that I would reckon that probably we could have that deal in place before the end of this calendar year, and with that at least the 25% punitive tariffs could be taken off, But having said that, I think India could still have a tariff about 20 or 25% on an aggregate basis from US. So essentially, the vantage point that India was looking forward to in terms of getting a very favorable deal from US in the in the early part of the year, I think that's clearly lost in that sense. And in that sense, it's possible that our tariffs could be higher than some of our competing countries. For example, Vietnam has got a trade deal at 15% tariff. So has South Korea and Japan as well. So probably we might not be able to benefit out of it, but I think that India could be in for a 20-25% normalized tariff. Having said that, all of us know Trump eventually chickens out, and which is where we've seen, if you see the series of events that have played out over the last 6 months, on every macro event that has happened, whether it's geopolitical or macroeconomic event, markets have largely held through despite so much of turbulence and uncertainty around these events. Indian markets have eventually bounced back, and that's primarily because markets believe that either these events are transitory in nature, they are not going to have a disruptive impact on Indian economy, and in case of geopolitical events, including the Israel-Iran war or the short war we had with Pakistan, market essentially believed that in case of Israel-Iran war, it will remain contained within that geography and it will not spill over to the rest of the world. And despite that Israel-Iran conflict, all through, meaning getting into 2 years, oil prices have remained very benign. So India is a big importer of oil, so India has avoided any external shock coming out of oil prices. Likewise, we saw in case of India-Pakistan war, while it was intense, but it was a very short war and India could bring it to a pause in a very short period of time. So far markets have primarily believed that in case of all of these macro events, that either they will be contained within the geographical boundaries of countries which are involved into it, and in case of macroeconomic events, markets still believe that they are transitory in nature and unlikely that they're going to have a disruptive impact on global growth or Indian economy, and which is why Indian markets have held through all of this. And I think so is the case with the Trump tariffs. Market still believes that probably by the end of the year we should have a deal in place. And I would, we at Reniso also firmly believe that it does make imminent sense for investors to not chicken out and to just fight this out kind of thing. I think eventually there is a trade deal that's there in the place, and which is why markets have been extremely resilient. So that puts in context, these two events from the point of view of their impact and what does it mean for markets. Just to give a slightly more broader perspective in terms of how the economy is shaping up and how do we think about markets from here on, given that we have taken these two events into stride. So clearly, I think all of us know that there's been a moderation in growth, or I would say there's a cyclical slowdown. India is in the midst of a cyclical growth slowdown. Our growth peaked at about 9.2% in FY24, and March 25 our growth had slipped to as low as 6.5%. I think my belief that our estimates is this year's growth will be something around 6.5%, will not be anything very different from what growth has been last year. And I think the significant stimulus, as we discussed, that the government has induced or injected into the economy will certainly put a floor to the downside floor to the economy. So despite the tariff headwinds and that India is facing, at least in the interim, the stimulus should provide a floor to India's growth, and I don't see India's growth slipping beyond that. Having said that, I still think that acceleration in our growth is sometime away, still at least 4 to 6 quarters away. So we envisage and we forecast probably India's growth at about 6.5% this year and something similar about 6.6% next year to that extent, because we clearly believe now that some of the benefits that we were earlier anticipating that India will accrue out of favorable tariffs from US versus our competing countries or neighbors will not accrue because India will get tariffed at 20-25%, which will be higher than some of our neighbors to that extent. But in a world which is so volatile, I still think that 6.5% growth is not bad. So our base case is that India continues to grow at that rate, and any meaningful acceleration in growth is at least 4 quarters away from now. More importantly, in all of this economic turbulence, what has really held India through is India's very stable macroeconomic fundamentals. If you see over the last 10 years, India's macroeconomic fundamentals have been very stable, and I've been highlighting this for a while. You see, last 10 years, India's growth has been, real growth has been about 6.5% despite the COVID shock. Last 10 years average growth is 6.5%, which is not bad. Government of India has been very responsible fiscally and very prudent in terms of macro managing the economy. Central government fiscal deficit, which did spike during COVID, has been brought down back to 4.8% last year, and this year the targeted budget deficit for the government is 4.4%. So India has done a meaningful fiscal consolidation of almost 4.5% in the last 5 years since COVID, and government has been very prudent in managing its finances. India's forex reserves have doubled in the last 10 years. We've gone from $300 billion to $700 billion plus currently. And one of the big challenge we had at 10 years back was a significant spike in retail inflation. But that has been brought down systematically. Last 10 years average inflation is about 4.5%. We know current inflation is much lower than that. And more importantly, one of the biggest vulnerability India had in the previous decade of current account deficit has been very much under control at under 1%. So I think the most important takeaway for me is this year has been a year which has been full of volatility and uncertainty, probably one of the highest uncertainty in a single year that I have seen in the last 25-30 years of my career. And what has held India through in this whole geopolitical macro uncertainty has been India's very stable and strong macroeconomic fundamentals. And I think this is where India scores over a lot of or most of our peers. I was talking about this. Government of India had a big spike in its fiscal deficit, going to 9.2% during FY21 in midst of COVID, when government had to do a big fiscal expansion to support the economy. But over the last 5 years, we've been very responsible and we've done a meaningful fiscal consolidation. We are back to 4.4% this year and probably under 4% by the end of this decade. So to that extent, government has done a fairly good job of managing the economy, and they've been very prudent in that sense. We've seen a very sharp drop in inflation that we have seen. Retail inflation, as reported, is down to about 2%, the lowest inflation that we've seen in the last 8 years. So that does reflect some underlying weakness in aggregate demand in the economy, but also that has opened up the window for RBI to do significant rate cuts. RBI has already done 50 basis points of rate cut, that we've 100 basis points of rate cuts we've seen this year so far in this rate cut cycle. I still think that we have another 50 basis points of rate cuts coming from RBI, probably one rate cut before the end of this calendar year and another rate cut in the first quarter of next calendar year. So, and that does help because it's a meaningful monetary stimulus in terms of reviving demand and reducing the cost of capital or cost of funds in the economy. The economy, friends, is coming out of a very sharp slowdown in discretionary consumption. I've highlighted this earlier as well. India's long-term aggregate consumption growth, or PFC, private final consumption expenditure growth, has been about 1.1x of India's nominal GDP growth, about 11.5% in the last 20 years. And the last 2 years, this growth has been, just about 6.5%. So it's about almost 40% below the long-term average. But we've started seeing signs of recovery in India's consumption expenditure. The slowdown, when it started 2 years back, started from rural India and then it spilled over to urban India. Rural India, when it comes to staples, has started showing very healthy volume growth, at least right from December quarter onwards. And over the last 2 quarters, that has only become more broad-based. More and more categories are showing far more encouraging signs of recovery. And I think with the stimulus that's been now infused into the economy, this recovery will really gather steam and will come very broad-based. So I think we are in midst of we're coming out of a very sharp or a very steep consumption slowdown in the economy. But more importantly, I think the consumption recovery in the economy from here will gather steam and will really build up from here in terms of a consumer recovery. I clearly see, because last 2 years growth has been very slow or modest, I also believe there is a lot of latent consumption demand that exists in the economy. there is consumption demand which exists, but consumers did not have the money in the pocket, and which is where they could not execute or buy those goods and services which they wanted to. And now with this stimulus and with prices of goods coming down with GST cuts, I think that latent demand will definitely come back into the marketplace, and I see, and which is what will drive very healthy recovery in consumption, I would reckon, over the next 6 to 8 quarters, and which also explains our constructive view on consumer as a sector. I'll talk a bit more about it when we talk about sectors, I feel pretty excited or positive about consumption recovery in our economy, friends. Yeah. To summarize all of this, how are we thinking about markets and economy? So we clearly think India is in the midst of a growth super cycle, and India growing at about 7.5% average over the next 7 to 8 years is a reasonable case assumption. It's neither overly optimistic, neither overly pessimistic, and that should lead us to an economy doubling the size from $4 trillion currently to $8 trillion over the next 7 years. So we certainly envisage India becoming an $8 trillion economy by 2032-33. And if that be the case, then I think it's a reasonable expectation for Indian equities to do about 14-15% CAGR from here over the next 7 to 8 years in the base case. And these are, I know last 1 year has been pretty challenging for equities. Last 1 year returns have been negative so far, but I also believe that probably the last year was a year of consolidation because of the cyclical slowdown in the economy and the lagged impact of that in terms of earnings growth. But all of those are behind us, and from here on we should start seeing markets delivering positive returns and getting back to its trajectory in that sense. Just to summarize, friends, the view. So I clearly think that the economy, the low point of cyclical slowdown in the economy is clearly behind us, and economy is on a path of recovery. Having said that, I must concede that I think the recovery in the economy will be somewhat gradual, and it's not going to be a hockey stick recovery, but it will be more gradual recovery which will build over the quarters. The slowdown in the economy did have a lagged effect on earnings growth. Nifty earnings growth were down to 5% last year, probably the slowest earnings growth that we witnessed in the post-COVID era in the last 5 years in FY25. But I think again the low point of earnings slowdown is behind us. Clearly this year we see Nifty earnings growth getting to high single digits, about 9% or so, or double digits 10%. But we clearly see India getting back to, or the Nifty 50 companies and the Nifty 200 companies getting back to mid-teens earnings growth next year. That is on a FY10 basis, because we think the consumption recovery in the economy should lift the growth in the economy. So clearly the earnings downgrade cycle is behind us, and more importantly, we see ourselves getting back to mid-teens earnings growth next year. Last 1 year, because markets have been flat, markets have consolidated. So India, which was trading at somewhat at a somewhat premium to all the other regional markets in that extent, valuations have moderated, and valuations are now pretty much in line with India's long-term averages at 21 times 1 year forward earnings, where Nifty 50 index is trading today, is pretty much in line with India's long-term average, where Nifty is traded over the last 20 years in that sense. Yes, FIs have continued to be a seller in the market, so the sell flows have been pretty strong all through the year over the last 1 year. But I certainly see them, that also turning around. It's a matter of time. But the good thing has been that DI flows have continued to remain very strong. So domestic investors have continued to repose their faith in Indian markets, and for rightly so. And the last thing is, while India has actually also had one of the biggest underperformance in the versus all the emerging markets in the last 1 year, probably the widest underperformance that I've seen going back all the way back to 1996. And that's primarily because while India had an earnings slowdown and a cyclical slowdown in the last 1 year, a year back India was also the most expensive market in the world, and it was trading at 20% premium to its own long-term averages. And whereas some of the other markets, including especially the North Asian markets or the South Asian markets like China and Korea, were trading pretty cheap, and these markets or these economies were having earnings acceleration, and they were very cheap in relation to India. Those markets have done phenomenally well. But having said that, I must also say that global investors clearly understand that while all of these North Asian markets are more a cyclical play on recovery in US tech or a cyclical recovery in growth, but when you want to play an economy and markets from a 10, 15, 20 years point of view, then India is the only secular growth story out there. So India has had a tough year in terms of performance of equity markets in the last 1 year, but I would like to think that the worst of underperformance of India is clearly behind, and from here on India should start performing and probably regain some of the retrace some of the underperformance that we've witnessed in the last 12 months. So the good thing is that probably looks like the low point of this underperformance is also clearly behind, and as we see earnings acceleration, we should certainly see market performance and more importantly reversal in foreign flows also down the line. So that's a quick summary on markets for and how we're thinking about some of these key issues and our outlook for markets and the economy, friends. With that, maybe I can quickly so that's in summary, that's how I think about it in terms of outlook going forward. I believe that all of us know Nifty index is trading at about 25 odd thousand. We still think that the Nifty can double over the next 6 years and get to 50,000 by 2031, and I think that's a reasonable case expectation given India's underlying strong growth, and now valuations are reasonable. So I think it makes imminent sense for investors to stay invested and probably keep allocating to equities, because I still think that on a 5-year basis India is the most compelling equity story out there outside of US. Maybe I can give you all a quick update in terms of how portfolios have done and how we're positioned, and we'll touch upon the performance as well, and then I'll open the floor for questions. So it's been almost a year. Last year, sometime around in the fourth quarter, October, December quarter, we took a stance. We turned positive on financials as a sector where we've been underweight for almost 2.5 years, and we increased the exposure to financials, and within that we said that we like the lenders and we like the large lenders in India. So financials is one of the largest positions for us across our portfolios, and within that at this point of time we are more biased towards lenders. I've said this in the past. We own 4 of the top 5 banks of India, right from HDFC Bank, ICICI Bank, Kotak Bank and SBI. So we like lenders because we think the worst of credit slowdown is behind us. As the economy recovers, consumption recovers, auto sales recovers, these banks are big time into lending into consumer loans across, be it personal loans or credit cards or auto loans and so on and so forth. They'll see a recovery in credit growth. We see credit growth getting back to 12-13% next year, and within that larger lenders will grow at a faster rate because they will take market share away from smaller lenders. And more importantly, valuations in the sector are very comforting. The sector trades at almost at about 20% discount to the Nifty index. So we clearly see over the next 3 years these companies delivering mid-teens to high teens earnings growth, and we certainly see some valuation uptick coming into financials as well. After a gap of almost 5 years, we are turning positive on consumption as a sector. For the last 5 years, we've avoided consumption as a sector because pre-COVID we said valuations were very expensive and we sold into consumer stocks in 2018-19. Last 5 years, we were of the view that there is India's growth will be led by investment cycle. So we saw a very strong investment cycle coming in, and we said consumer as a sector will underperform. But now, after a gap of almost 5 years, what we are really seeing is that the consumption slowdown that we witnessed in the last 2 years has really troughed out. From here on, we see acceleration or improvement in consumption growth. More importantly, because of the last 5 years of underperformance, valuations across the consumer sector, be it staples or discretionary, have normalized. So valuations are not cheap. They are certainly not cheap. But what I would like to say is they are pretty much normalized valuations, which effectively means from here on we can see returns in line with earnings growth, and I see earnings acceleration into the entire consumer sector across staples and discretionary. So consumers have become a large part of our portfolio now, and probably the second largest exposure across our portfolios now. And as I said, we're investing into, or we've come back to the consumer sector after almost a gap of 5 years, which reflects our deep conviction in the growth recovery in the sector, friends. We've stayed invested, we've been invested into IT as a sector while it did well for us in CY24. But this year has been a challenging year for IT services company, but we've continued to hold on to our exposure. And this year has been a challenging year for the sector. The stocks have been down almost about 18-20% on a YTD basis, and that's primarily because of 2 or 3 macro narratives which are overriding the sector. One was primarily concerns out of impact on IT services companies because of AI driven displacements that could happen in the sector. And second, there was this whole fear about some sort of tariffs or trade embargoes coming on IT exports as well, and we did see some of that come in the form of extra fees or higher fees that has been imposed on H1B visa. But having said all of that, we still continue to believe that basis very detailed engagement that we've had with the entire sector, companies across the sector. I've personally spent a lot of my time in the last quarter in meeting top management and CEOs of some of the leading IT companies of India, both across large cap and mid caps. And also I've been a participant into a few AI conferences to understand how AI will change the landscape for the world, but more importantly to begin with for IT companies. All I can tell you, friends, at this point of time, we feel constructive and positive in IT as a sector. We don't think so. While there will be some displacement that will definitely happen because of AI for these companies, but I think that's very much manageable. And more importantly, over the medium term, after my conversation with all the leading IT companies, I have come back with a reaffirmed conviction that over a medium term, 3 to 5 years, AI will be beneficial to IT companies and not destructive or harmful to IT companies. AI will create more work, more opportunities for IT companies, and it will increase their TAM. So we have continued to hold on to our IT exposure despite the sector not doing well, and if at all anything, some point of time when we get more concrete signs, probably we could add to our exposure as well. Apart from IT, in the last quarter, we also increased our exposure to internet. Across our portfolios now, internet is a meaningful exposure and almost close to double-digit exposure in our portfolio. We clearly see this sector growing into, at a pretty high rate, probably 20% plus or 25% over the next at least 7 to 8 years. And it fits into a classical investment framework of investing into companies which can deliver sustainable high growth over a medium term to long term, and which is, we think, where clearly the sector is poised. And more importantly, because of the rapid pivots a lot of these companies have been making, now many of these companies have turned profitable, and we clearly see that these companies generating huge amount of cash flows over the next 5 years as they make pivots in their business. So we clearly like that sector. I'll talk a bit about our exposure to the sector, but clearly the sector is a more medium-term, long-term bet for us, and we continue to remain very constructive on internet companies and internet as a sector and companies within the sector. And as I said, it's almost 10% allocation for us across our portfolios. Quick update, friends, for all of you all on our portfolios. As all of you all know, Renaissance Opportunities is our large cap PMS. We've been running this strategy for over now close to 7 years, and more importantly, last quarter we did also launch an open-ended AIF on the same strategy. So now we have the strategy both on our PMS for the last 7 years, and now we also have an open-ended AIF structure for the fund. As you can clearly see, in line with what we discussed, if you see the top 3 sectors, which is what we discussed, BFSI, financial services, consumer discretionary, information technology, which is IT services, and internet. So these 4 sectors, which is IT services and internet taken together, these 4 sectors now almost constitute 75% of our portfolio. So while the portfolio is well diversified across 10 sectors, but clearly these 4 sectors is over 75% of the portfolio. From a fundamental perspective, the portfolio had a pretty healthy 11% earnings growth last year. This year we have taken as a year of portfolio consolidation. So portfolio earnings growth are pretty much in line with the Nifty earnings growth at about 9%. But we see the portfolio getting back to earnings acceleration next year. While Nifty earnings growth are expected to be about 14-15% next year, we expect portfolio earnings growth at about 18% next year. And more importantly, while the Nifty index is 21 times 1 year forward earnings on FY27 basis, the portfolio is about 17 times on FY27 basis. 17 times on FY27 basis, which effectively means the portfolio has about 20% higher earnings growth than the Nifty index on FY27 basis at a valuation which is 15% lower than the index. So we clearly see that over the next 1 year, as markets move from FY26 to FY27 earnings, we should see a meaningful alpha coming out of the portfolio. A quick update on performance. Last 1 year has been somewhat challenging for the fund. It has underperformed the index by about 4.5%. But despite that, if you see the 3-year, 5-year performance or the 7-year performance has been pretty healthy. Last 3 years ending August 25, the portfolio has done 15.36% CAGR versus Nifty 50 TRI of 12.5%. And the performance for other periods are 5 years and 7-year performance are there for you. I've said this before, maybe I just highlight this once again for benefit of everyone. This chart is a representation of a 3-year rolling alpha on a monthly basis, 3-year rolling alpha that we've been able to generate. These bars represent annualized alpha on a 3-year rolling basis. So if you see, all these bars are positive or upward sloping, there are no downward sloping bars, which effectively means any investor who's been invested into the strategy and stayed with the strategy for the last 3 years has experienced positive alpha. So 100% of our investors who invested with us and stayed with us for 3 years have experienced returns in excess of the index. We've been able to generate alpha for them. And more importantly, we've been very disciplined with our risk processes. If you see, we have very tightly managed the portfolio risk between 0.94 and 1 beta. So all the excess returns that we've generated that while taking market risk. We have not taken higher risk or risk higher than the market to generate those excess returns. And that's the value we've added for our customers or clients. And as I said, I'm very pleased to see this, that 100% of our clients have experienced alpha as long as they've stayed with us for 3 years. Likewise, I did touch upon this. In the interest of time, I'm going to skip this, but we can always come back in terms of what are the changes we've made in the portfolio over the last 1 year. Clearly, I've discussed about that in terms of we've added weightage to financials and consumption and internet, and we've taken that money out of some of the investment oriented sectors and some of the more expensive names out of stocks out of across sectors. So that's primarily what it reflects. A very quick update on our FlexiCap portfolio, that's the India Next PMS. As all you all know, this strategy is available both on the PMS and the AIF platform. We launched an AIF on this strategy in January this year. Currently, as you see, the portfolio is about 55% large cap and the balance 45% spread across evenly spread across mid and small cap. So very judicious allocation. In terms of sectoral exposure, again, the 4 sectors we spoke about, which is financials, IT and tech, and consumer, constitute about almost 65% of the portfolio. So that reflects our outlook or constructive view on those 4 sectors. Portfolio again looking at about 19% earnings growth next year, and a portfolio which is at a 15% discount to Nifty 200 index, despite higher earnings growth. But portfolio has done pretty well, though last 1 year has been somewhat challenging once again. The portfolio is down about 6.7% versus Nifty 200 TRI down being 4%. But despite that, usually last 3 years numbers have been pretty healthy at 20.17% CAGR over 3 years versus Nifty 200 TRI of 13.8. The 5-year and 7-year numbers are equally healthy and places this portfolio amongst one of the best performing portfolio across all FlexiCap funds, across mutual funds, PMS and AIF. Probably it's ranked, on a 3-year, 5-year basis, it's ranked among the leading strategy across mutual funds, PMS and AIF. Again, a very disciplined execution on risk and portfolio performance. You see 100% of our clients who invested with us and stayed with us for 3 years have experienced alpha. These are monthly rolling alphas, 3-year monthly rolling alphas on 3-year annualized monthly rolling alphas. Let me get that right. And as you see, the strategy has generated alpha for 100% of our clients. And while doing that, we've been very disciplined about the risk that we've taken. We've very tightly kept the portfolio beta at 1. So we feel pretty pleased about the outcomes that we've been able to achieve for our investors, friends. The fund also has a AIF in place, so these are performance updates on some of our close-ended AIFs as well. The AIF 2, 3, which are in force, but we've stopped taking money in those funds. Again, those funds have done pretty well. AIF 2 has been doing about 16.7% CAGR over the last 3 years versus Nifty 200 of 12.7%, and AIF 3 has done 15% CAGR in the last 2 years versus Nifty returns of 12.5%. The AIF 4 has done pretty well over the last 6 months as well during its existence. So with that, friends, maybe I can quickly I'll take a pause. I'm 45 minutes into the conversation. I can see a lot of questions that have emerged on the question box. So let me try and take those questions one by one so that we can cover maximum ground in that sense. Yeah, just give me a moment. Probably the first question is from Bhushan Bora, and his question is, with Trump's policies creating global economic uncertainty, when do you think Indian markets will stabilize? Well, Bhushan, as I said during the course of my presentation, I probably think the low point for Indian markets and the worst of economic slowdown on macro uncertainty for India is behind us. I certainly see growth recovering in the third quarter because of the stimulus and impetus that the government has done. And gradually I see the trade-related headwind because of tariffs will also weighed off. So I think from here on we should start seeing recovery in Indian markets. So I see markets not only stabilizing, but I think my assessment is probably markets will start clocking positive outcomes or returns from here on over the quarterly basis. The next question is from Vipul. What level do you expect on Nifty index over FY 27-28? Well, Vipul, as I said, I think India can comfortably do a 14-15% kind of return on the Nifty index and an earnings growth. Indian markets will get back to, Nifty 50 and the Nifty 200 companies will get back to mid-teens kind of earnings growth in FY 27. And if with that being the case, I think it's a reasonable expectation for Indian markets to do 14-15% kind of returns over the next 12 months. The next question is from Mangla, and her question is, what is going to drive this significant recovery in earnings? Does this therefore imply that banks and IT are likely to see a big recovery in earnings? Because these are the biggest sectors in the index. You're absolutely right, Mangla. One, I think banks has had a headwind this year because of very sharp rate cuts that the rate cuts by RBI has been front loaded, and where we got 100 basis points of rate cuts in a matter of 5 months, and we got 150 basis points of rate cut. The way banks balance sheets are and the way RBI regulations are, assets on a bank's balance sheet gets repriced much faster than the liabilities because the duration of liability is much longer. And because of which banks margins have been impacted in the first quarter, and there will be some rub-off effect in the second quarter as well. So while this year's earnings have been impacted because of margin compression, next year I think margins will normalize. So margins will improve in next year full year basis, and we will see credit growth recovery happening in the next year. So I certainly see larger banks doing mid-teens to high teens kind of earnings growth going into FY 27. And as far as IT is concerned, while this year is the third successive year of probably mid-single digit to high single digit earnings growth in IT sector, I certainly see that improving next year, because bear in mind, I've been saying this, this is the third successive year of slowdown in global IT spends. I have not seen in the last 28 years IT spends being held back for 3 successive years. And given the fact that the world is in midst of such a big technology shift and transition with AI, large global corporations, Fortune 2000 and Fortune 5000 companies cannot hold back IT investments. It can be significantly lethal for their business. It can disrupt their business. So large corporates will have to spend on IT upgradation on and will have to make AI investments. So I certainly see a meaningful delta or improvement in earnings growth for IT sector going into the next year, because I don't, from my conversation with IT companies and also CIOs of some very large companies, they cannot hold back. So I think there is a latent IT spend which is held back by companies, which will come back into the market next year, and that should drive growth for IT companies. So I certainly think that growth next year will be driven by both banks and IT. Good question. The next question is from Mr. Jagdish Kumar Savani. Developed economies face challenges and recession fear. How will Indian market be affected 1 or 2 years down the line? I think that's what his question is. Well, I still don't think so. While there are macroeconomic uncertainties, but I don't see US or Europe slipping into a recession, at least not in CY 26. So I don't see a recession is on the cards to that extent. India will certainly do better than those economies. This year has been a year of macroeconomic uncertainty, and more importantly trade related uncertainty, which has compounded the impact for India. But hopefully we are able to get over this probably by the end of the year. So next year India will do better. Irrespective of whatever happens to global economies, India, I still think is India will do 6.6, 6.7% growth next year, and which is good for us to do a mid-teens kind of earnings growth for corporate India next year. So I think the outlook for India remains constructive despite challenges which global economies might face next year. What is the impact? Next question is from Praveen Kashid. What is the impact of H1B visa restriction on IT sector? So, well, Praveen, in the near term, it does not have significant impact, because this is the $100,000 of extra visa fees is for new visa applications and not on the renewals or existing H1B visa holders. Large IT companies already have a significant part of their workforce in on-site workforce, which is in US. Either they are on green cards, which means they have American citizenship, or they have a large pool of workforce which already has an existing H1B visa, and their dependence on H1B is very low, just about 5 to 10% of their on-site workforce. So while it will have some cost over a medium term, not on an immediate basis, but we don't see it having a meaningful negative impact on IT companies. So I think IT companies can deal with it to that extent. The next question is from Amit Jain. IT and pharma has been a drag on your portfolio. Your view, please. Well, you're right, Amit, that this year has been a challenging year for IT and pharma, and that's primarily because of the macro narrative around tariffs being imposed on pharma companies, or trade embargoes being imposed on Indian IT exports. But now that we've seen large part of US policy announcements, as we see H1B visa fees does not impact IT companies in a material negative manner. And as far as pharma is also concerned, the US has stayed away from doing anything or imposing any tax or tariffs on generic pharma exports. So the narrative has impacted this sector, but I think the sector is still in for a very healthy growth in that sense, and we think the sector should come back, or the companies should do well next year, because underlying earnings growth still remains very much in place for the sector. So, these kind of things can happen for a period of a year or something like that when we're investing for long term. When we're investing, also bear in mind, when we're investing in companies, we're investing with a 3 to 5 year time horizon. So, these companies can have one bad year, and these are things which are outside the control of these companies. These companies do not control the narrative or government policy making. So, there's very little they can do about policy making of the government. So, having said that, we think probably the worst of narrative fear or the overarching, negative narrative on these sectors is behind us, and we see sectors doing well going into the next year. Saurabh Singh has another question: why so much overweight on BFSI in the portfolio? Well, Saurabh, one, we are not overweight BFSI as a sector, because the sector itself is a very large weight in underlying index. if you see Nifty 50 index, BFSI across everything taken together is almost about 35% of the index, and even in Nifty 200 index, top 200 companies of India, it has 30% weightage. So our weightage for the sector is pretty much in line with index weights, though our stock selection is very active. But having said that, we think that the reason for having high exposure to the sector is because we think that the sector is in for very healthy earnings growth over the next 2 to 3 years, and more importantly, valuations in the sector are very reasonable, and these kind of valuations, or I'm seeing after a very long time. HDFC Bank trading at about 16 times 1 year forward earnings. I haven't seen HDFC Bank trading at these kind of valuations in a very long time. So we find the valuations very attractive, and as I said, we believe the sector has very healthy earnings growth ahead of us over the next 2 to 3 years, and which is why we have such a significant exposure to BFSI as a sector. The next question is from Gaurav Chaudhary. Reason for India Next recent 1 year underperformance and actions taken. Well, Gaurav, as I said, we have exposure to IT and pharma that has not done well this year, but we have continued to hold on to our exposure. We still think that the portfolio is very rightly placed. You see, the portfolio has had a very strong earnings growth and performance in terms of returns over the last 5 years. There could be a year where portfolio can marginally underperform, but we think the portfolio will get back to outperformance from here on, and we don't feel too concerned about 6 months 1 year performance, because we invest with a 3 to 5 year time horizon, and we certainly seeing the portfolio will get back into traction from here on, because the underlying foundation of our portfolio or our investing ethos in terms of investing into high quality, high growth companies with reasonable valuations are very much in place. Markets itself have been into a consolidation phase over the last 6 or 9 months, and where some of these high growth companies which have done very well over the last 2 or 3 years have had some profit taking, but underlying companies remain very strong, and which is where we feel pretty good about our portfolio. The next question is from Divesh Shah. Why did you add Swiggy into your portfolio rather than going for Eternal or Zomato? Nice question, Divesh. We do have an exposure to Zomato indirectly, Divesh, through our ownership in Naukri, the parent of Zomato, which we've been holding for a long period of time, and it has done pretty well for us. We like the space in terms of what Zomato and Swiggy are doing. We continue to remain positive in both the segments of the business, which is food delivery and quick commerce. But we clearly think that while a lot of low-hanging fruits in terms of operating leverage and pivot from loss to profit in Zomato has been demonstrated in their quarterly numbers and their financial results, and as a consequence, that has been captured in terms of market price and valuations. And the same thing, that sharp pivot that has happened in Zomato in the last 8 quarters will happen, we think, in the next 8 quarters in Swiggy. So we clearly see a very strong pivot in Swiggy over the next 8 quarters, from the company going from profit to loss, and significant operating leverage from going from loss to profit, I beg your pardon, and a significant operating leverage playing out in terms of the operating numbers. And as they demonstrate that, we think the potential returns by virtue of stock getting repriced in Swiggy are higher than Zomato, and which is where, from a potential returns perspective, we think Swiggy can deliver higher returns over the next 6 to 8 quarters, next 4 to 8 quarters versus Zomato, and which is where we've made the switch to Swiggy versus Zomato. Good question. The next question is from Anuradha Vijay. How long the market is going to be sideways with no particular direction? Well, Anuradha, I don't have a specific answer to this question, but my view still remains that the worst of earnings slowdown is behind us. From this quarter onwards, we'll start seeing recovery in profit growth in corporate India, and markets always forward looking. If that is the case, we will see traction in equity markets from here on. I certainly see, my view is, I don't know exactly the time, but in the next 3 to 6 months, I certainly see markets making a new lifetime high. So probably I think in the next 3 to 6 months, we'll see a new lifetime high in the market. The next question is probably, we are dot on 5 o'clock, friends, or thereabouts. probably just one more question, the last question I can take from Mittal Bain, which is how is Renaissance beating the frequent market outlook changes due to US tariff change, India's GST change, etc. Well, ma'am, what we try to do is we try to think about our companies and sectors from a slightly more medium term perspective. We try to, when we are taking an investment decision and we are doing an investment research, we try to think through all the known facts or risks that lie on the horizon in terms of what could be the potential impact if in case they fructify. And obviously we try to think through some of the unknowns as well, because a lot of things are unknown as well. To the extent we can think about them in terms, and we try to take the path of, I always say that we try to take the path of least resistance. So we try to invest into companies or businesses which we think will be least impacted because of any of these macro headwinds, and which is where we are very careful and while in our initial stock selection to avoid or mitigate a lot of this risk at the early stage itself when we are doing our investment research. And that does help us in that sense, because some of those risks eventually fructify and become real, and they become real because we have thought through it and we've selected companies which will be less impacted or immune to those or can tide over those risks. Our portfolios tend to be relatively immune to those risks. So obviously I would say forward thinking and trying to think holistically or comprehensively about both known knowns and unknown knowns, is what we try to do on a day in day out basis as a part of our investment research process, and probably that helps us or gives us some edge over some of our peers. And the last thing is, as I said, we're always thinking slightly more medium term, long term. We're not thinking short term over the next 3 months, 6 months in terms of an investment decision. So that also helps to that extent. So I hope I've been able to answer your question, but in case if not, I'm happy to engage for a more detailed discussion. With that, friends, I've tried to cover most of the questions that were thrown at us. Maybe I can see there are quite a few questions which we're not able to cover. We'll certainly get back to you with a feedback or a reply on your questions. And if you have any more questions, feel free to write to us or get in touch with our team. With that, we're already on the hour. So with that, let me call a close to this webinar. I'm happy to engage with all of you all during the course of this quarter, and we'll talk to you again into the new year at the end of the December quarter. With that, my best wishes to all of your friends and your families for the best of festivals, including the Diwali and New Year. Thank you. Thanks a lot.